I see ultimately an inflationary endgame, despite right now a disinflationary period, which is the natural result of rising rates, declining bond prices for a number of reasons. In the next 6 years, we're going to see the inevitable historical movement of currency destruction due to debt. The simple syllogism throughout history is when you have a country that's massively over its skis in debt, 120% debt to GDP, 8% deficits, et cetera, the debt is obvious. The Congressional Budget Office is going to promise us another $20 trillion debt in the next 10 years. So when you have a debt crisis, that leads to a sovereign bond crisis, which then leads to a currency crisis. And they're going to have to, in my opinion, monetize that debt in some way. There has to be demand. If that's not natural demand, it has to come from something. I think that will come from the central bank. They will debase the currency to save the system, and that will be inherently inflationary.
MatthewPiepenburg, a partner at Greyerz Gold, predicts currency depreciation by 2030 due to mounting debt levels. In December 2023, total federal debt reached $33.1 trillion. With $26.5 trillion held publicly and $12.1 trillion intra-governmental. The erosion of domestic purchasing power has been significant since 1933, with a 92% loss in the value of the US dollar. Even with a moderate 1994 inflation rate of 2.7%, projections indicate a further decline in purchasing power by 2022. This drives up prices of precious metals like gold and silver. For instance, in April 2011, gold hit $1,500 per ounce as investors reacted to declining fiat currencies, signaling doubts about global economic stability. Matthew outlines a series of interconnected crises triggered by a looming debt crisis, culminating in a sovereign bond crisis and, eventually, a currency crisis. Global debt has reached alarming levels, accounting for 336% of the global gross domestic product. This stark increase contrasts sharply with the average debt-to-GDP ratio of 110% for advanced and 35% for emerging economies in 2012. According to the latest Global Debt Monitor report by the Institute of International Finance, this ratio was 334% in the fourth quarter of 2022, indicating a concerning trend of escalating debt burdens. Matthew suggests that the imperative to roll over debt and bolster the economy will likely compel central banks to enact monetary stimulus measures. Federal Reserve Chair Jerome Powell recently addressed the nation's mounting debt concerns during an appearance on CBS's 60 Minutes, warning of the U.S.'s unsustainable fiscal trajectory. In contrast to the prevailing deflationary narrative, Matthew contends that the outcome will be inflationary, driven by central bank interventions to stabilize the system. Indeed, inflationary pressures are already evident, with the Consumer Price Index registering at 3.4% in December. In light of mounting debt levels, currency depreciation, and inflationary pressures, the outlook for gold and silver remains bullish as investors seek refuge from the uncertainties plaguing traditional fiat currencies. Join us as we delve into insights shared by MatthewPiepenburg. To stay updated with our latest uploads, subscribe to our channel and activate notifications. Thank you.
The Fed does a really good job because on that trilogy of, debt crisis, credit crisis, currency crisis, then is a centralization crisis. And part of that centralization is messaging. This sounds conspiracy theory, but messaging control, what's not discussed, what's omitted from the daily dialogue and the mainstream media or even the alternate media. Well, what's omitted are these hard facts on the ground. Let's just ignore them. Let's be calm and carry on. As it builds resentment, that's hard to quantify, mistrust, whether it's on Main Street, whether it's with the world reserve currency, whether it's with weaponizing, whatever debate you pick. It could be geopolitics, could be crypto, could be currencies, but there's a growing distrust that's somewhat palpable. But can we cut spending? Can we cut entitlements? Can we cut the military? Can we do it like with a chainsaw in the West? I don't think so. So we'll postpone, go further and further into debt, and debase the currency. And Rick has always said, I don't want to see gold. I buy gold because I'm afraid it's going to go up. But I think deep down, Rick, it's going to, well, you don't know. I'm not going to say but you feel like it very well could go up. And it's not so it makes you richer. It keeps you from getting poorer. I see ultimately an inflationary endgame, despite right now a disinflationary period, which is the natural result of rising rates and declining bond prices for a number of reasons. In the next 6 years, we're going to see the inevitable historical movement of currency destruction due to debt. And I think the simple syllogism throughout history is when you have a country that's massively over its skis in debt, 120% debt to GDP, 8% deficits, et cetera, the debt is obvious. The Congressional Budget Office is going to promise us another $20 trillion debt in the next 10 years. So when you have a debt crisis, that leads to a sovereign bond crisis, which then leads to a currency crisis. And they're going to have to, in my opinion, monetize that debt in some way. There has to be demand. If that's not natural demand, it has to come from something. I think that will come from the central bank. they will debase the currency to save the system, and that will be inherently inflationary. So I think right now, as we're all talking deflation and Powell's won the war and the victory dance is being made, I think the net result actually is an inflationary feature to save the system, which in a perverse way could actually be good for stocks over the next couple of years, depending on the nature of the pivot and whether we just have a rate cut followed by QE to the moon. But ultimately, I see an inflationary endgame, which is not the end of the world, but it certainly changes the dynamics. In terms of recession, I've been arguing all year that we're actually in a hard landing based on old school things like the leading indicators, the conference board leading indicators, money supply changes. But again, those could all be finally debated, but the 4% threshold on the conference board, that was last December. The year before that, we did have consecutive negative GDP, but that wasn't a recession because employment was so good. But then even the employment, the BLS, what it does with inflation, what it does with employment data, we can argue back and forth. It's not exactly honest, in my opinion. That's not meant to be exaggerating or sensational, but there's some questions there. I think in many ways, the layoffs, the bankruptcies, the Oliver Anthony indicator in Farmville, Virginia, all these things to me suggest a hard landing is already here, supplanted or kind of hidden or masquerading behind a ripping S&P that in an ironic way could be further tailwinded by rate cuts, for example. They haven't happened yet, but they're projected. I think they will happen given the debt rollovers on the S&P, given Uncle Sam's need to reprice debt over the next 36 months. So I do see the rate cuts as inevitable. I do this time. I was wrong last year after the regional bank crisis. I really thought that BTFP stood for buy the frickin' pivot. Like that was going to be then. The rate cuts were going to happen. And Powell, to his credit, is in some ways acting more like Volcker than I thought he could do for long. But again, I think in a lot of ways we are already in a recession. Will that recession deepen or be hidden by a Fed-supported centralized S&P and Dow and NASDAQ? These are questions I don't have all the answers for, but I don't see how you can postpone constructive destruction by having a centralized economy with centralized S&P. But that S&P bubble is benefiting the top 10%, not the bottom 90. What happens to that bottom 90? What happens on Main Street?
Matthew foresees a future marked by persistently negative real interest rates, regardless of official inflation indicators, such as the Consumer Price Index or the Personal Consumption Expenditures Index. This outlook suggests a significant departure from traditional monetary policy, with the Federal Reserve possibly concluding its historic interest rate hiking campaign by implementing negative real rates. Although metrics like the Fed funds rate minus headline annual PCE or CPI inflation provide a rough estimate, they may not capture the full impact of negative real rates on individuals and the broader economy. Matthew emphasizes that negative real rates contribute to currency debasement, eroding fiat currency's purchasing power over time. Moreover, Matthew cautions about the potential social ramifications of economic instability fueled by excessive debt, manipulation in credit markets, and currency devaluation. As countries grapple with servicing their debts, it is anticipated that approximately 100 nations will be compelled to slash spending on critical social infrastructure, including healthcare, education, and social safety nets. Let's get back to the interview.
I see a future in the next 6 to 10 years of extreme negative real rates, regardless of what the BLS tells us what the CPI scale is, which is an open fiction on Wall Street, but that's not a conspiracy theory. And this was a conversation with Russell Napier years ago, before inflation was the topic du jour, who was a staunch deflationist before he not because I changed my mind, but he saw it. Matt, every debt soak regime needs negative real rates to get themselves out of debt. So we're gonna have negative real rates, regardless of what the official CPI scale says. That means more currency debasement. So we can continue this charade at the expense of the purchasing power of our currency, the value of the fiat currency, and that will ultimately affect the middle class far more than, even though it hurts and annoys us, it debilitates them. And so that social unrest component of this comedy we're playing with our debt levels, our credit markets, and our currency, that social unrest is hard to predict and quantify and objectively determine what is unrest. Is it January 6th? Is it, identity politics? Is it the rise of X or Y leader? Will it be clean before then? I don't think we're going to see pitchforks. We could just have a very dumbed down population that's told to be afraid of something else while we continue this ridiculous credit expansion that we can't afford. Yeah, I think that's a really important point, Rick, this off-balance sheet debt, that kind of is ignored in the 120 or these other deficit numbers. And it reminds me of kind of a cryptic comment that Luke Roman recently made. He says, we could cut entitlements by 40% or military budgets by 40%, but that's going to be political suicide in this Western hemisphere. And maybe in Argentina, you could take a chainsaw to some of that and get away with it because they're so desperate. And in America or in the West, you're not going to get elected on that kind of honesty or that kind of constructive destruction. Can we have an electoral scenario where you have choices between people who generally worry about the state of their country more than re-election or vanity or income or popularity? And that requires the kind of courage to not be popular, to discuss things like family members do around a table when they have more debt than income, and the Porsche isn't going to be bought, or Exeter or Choate are out of the equation this year, or the second home isn't. In other words, can we be honest with each other? I think Americans could tighten their belt and come together as they've done in the past if they trusted their government, their system, their currency. I think that trust is palpably absent today. That's why we have opportunists.
As governments and central banks navigate the challenges of mounting debt and currency instability, the allure of gold and silver as safe haven assets remains strong. Investors may increasingly turn to these precious metals as reliable stores of value amid economic uncertainty. Consequently, the demand for gold and silver could continue to rise, bolstering their prices and reinforcing their role as essential hedges against the risks inherent in the global financial landscape. Are there any potential regulatory or policy changes that could affect the gold and silver markets? And how should stakeholders prepare for such developments? Share your thoughts in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.